Welcome to Case Study Series in Strategy. Case study by skilled MBA FlyBig, a regional airline in India, focuses on Tier 2 and Tier 3 cities, achieving profitability within 2 years. It specializes in routes ignored by major carriers and operates under the government's Ude Desh Aam Naagrik regional connectivity scheme, targeting underserved market segments. FlyBig has carved a niche in India's regional aviation by focusing on Tier 2 and Tier 3 cities. Achieving profitability in 2 years, it specializes in routes overlooked by major airlines. Operating under the Ude Desh Aam Naagrik scheme, FlyBig capitalizes on government incentives to enhance regional connectivity. India's regional aviation landscape offers immense potential with over 400 airstrips, yet less than 25% are commercially serviced. Economic growth in Tier 2 cities is accelerating, with disposable income rising 1.5 times faster than the national average. The Ude Desh Aam Naagrik scheme supports this growth by offering funding, tax reductions, and fee waivers to enhance regional connectivity. FlyBig has established a profitable business model in a challenging sector, leveraging its first-mover advantage on several regional routes. With a lean operational structure and strong relationships with regional airports, FlyBig operates 12 routes with 8 aircraft, maintaining an impressive 85% load factor, indicating high seat occupancy and efficient operations. FlyBig stands at a strategic crossroads as 2025 nears. With a profitable niche in underserved markets, the challenge lies in determining the pace and scope of expansion. Balancing growth with maintaining a successful operational model is crucial, as various expansion strategies present unique risk-reward profiles. Route selection is crucial for FlyBig, focusing on markets with sustainable demand that leverage its competitive edge. Balancing expansion pace is vital to maintain service quality and financial stability. Capability development requires strategic investments in fleet, personnel, and infrastructure to support growth effectively. The Indian aviation industry faces challenges like historically thin profit margins, averaging 3.2%, and volatile fuel prices, which constitute 35 to 40% of operating costs. Additionally, the complex regulatory environment, infrastructure limitations at regional airports, and seasonal demand fluctuations in smaller markets add to the operational complexities FlyBig must navigate. The competitive landscape in Indian aviation is evolving. Major carriers like Indigo, Air India, and Vistara are expanding regionally. Regional specialists such as Alliance Air and Star Air face direct competition. New entrants like Akasa Air and Ude Desh Aam Naagrik participants intensify competition. International airlines are forming partnerships with Indian carriers to tap into regional feeder traffic. Aggressive growth involves tripling the fleet size in 18 months, expanding to over 30 new routes, and significant capital investment through debt and equity. Rapid hiring and training are essential. This strategy aims to secure a first-mover advantage in untapped markets, promising substantial annual revenue growth but with higher operational risk. Measured growth involves doubling fleet size over 36 months, targeting 15 strategic routes, and using balanced financing with a lower debt ratio. This approach emphasizes gradual capability building and organizational development, ensuring profitability for each new route before further expansion. It projects a 35% annual revenue increase with a 12% lower operational risk. Analyzing FlyBig's growth strategies, we identify key strengths like a proven profitable model and government Ude Desh Aam Naagrik support. However, weaknesses include limited capital reserves and information technology infrastructure gaps. Opportunities abound with over 200 unserved routes and rising regional travel. Yet, threats such as fuel price volatility and major airlines' regional expansion pose significant challenges. FlyBig's expansion relies on 5 key success factors: selecting optimal routes, ensuring operational efficiency, managing capital wisely, navigating regulations adeptly, and developing talent. Balancing these elements while maintaining a lean cost structure and high service quality is crucial for sustainable growth. The consulting team recommends a phased approach for FlyBig's expansion. Phase 1 focuses on strengthening systems and selecting initial routes. Phase 2 involves deploying aircraft to high-potential routes with strict performance monitoring. Phase 3 accelerates growth, scaling rapidly once operational excellence is demonstrated across the network. FlyBig's success hinges on balancing speed with stability, ensuring expansion doesn't undermine operational discipline. Maintaining regional expertise and community relationships is crucial for competitive advantage. In India's volatile aviation market, building financial buffers and operational flexibility is essential to withstand potential headwinds. Thank you for watching. For more insightful case studies, subscribe to the Skilled MBA Strategy series. Navigate strategy one case at a time with us.